Tim here from Oracle Investments. Thank you all for coming back. Today we're going to discuss Tesla's Q3 earnings. And before I get started, I want to thank you all for being here. Appreciate you coming on and watching. If you haven't yet already done this, please subscribe, like the channel. I'm trying to grow this. Leave any comments down below if there's anything else you'd like to see, any adjustments you'd like to make. Again, I'm learning, new. So let me know. I appreciate all the feedback. So to get into it, Tesla's earnings call, personally, my opinion was they beat. Everybody knew that they were going to beat their earnings. No fanfare, no flair. Elon was not on the call, and he's usually the one who adds some sort of hints here and there along the way. Tesla fans love Elon. Wall Street does not. So it's kind of a toss-up. So it was kind of a generic, bland earnings call, but still a solid one, a good one overall. The huge surprise was the margin. That was kind of one of the things that a lot of people assumed was going to get better. That's what Tesla's been focusing on. But I don't think a lot of people knew how much it was going to explode.
We're continuing to make great progress as a company, setting new records on each of the most important financial metrics for Q3. Overall, we delivered just over 240,000 cars, 20% higher than last quarter and 70% higher than the same quarter last year. We were also able to achieve an annualized production run rate of over 1 million cars towards the end of the quarter.
So if you see here, Zach is talking about their end of the quarter run rate is already at a 1 million annual capacity. So with just two gigafactories that aren't even at full ramp yet, they're pushing 1 million. And they have two new factories between Berlin and Austin that are going to be pushing even higher than that. Those have significantly higher capacities. And so if each one of those ramps up at the same speed as Shanghai, then by this time next year, we should be seeing close to a 2 million annual run rate.
The increase in production rate has primarily been driven by further ramping of the Model Y at our Shanghai factory. Additionally, we have made great progress increasing production volumes of Model S and have recently started the ramp and deliveries of Model X. It will take a bit more time to get this program back to prior volumes, but based on demand, we are targeting to exceed historical production levels.
So the little nugget I took away from this was, as far as margin goes, they just started ramping up the S. They're just about to start producing the X again, and those are the high margin vehicles. And the Y is ramping up even more in Shanghai. And that's also another high margin one, especially when it's sold locally, because obviously their local deliveries are higher margin than their exports. So between the S and the X alone ramping up higher going forward, that means their margins are going to push even higher in the future.
We have also completed the transition of our Shanghai factory as our main export hub. This has enabled us to supply more vehicles to the North America market and to introduce Model Y to Europe. Due to part shortages and logistics variability, we have not been able to run our factories at full capacity.
Again, Zach here is reiterating the fact that the two factories they have, due to supply shortages, have not been able to be run at full capacity. Yet they're still hitting a 1 million annual vehicle run rate, which is insane. So honestly, the only thing holding them back at all is the supply chain issues. They have everything else working in their favor. They're always trying to improve. And so the sooner they can get the supply chain issues resolved, the sooner costs for those supplies will come down, and the sooner they can ramp up even faster.
Despite these increases in production and generally higher prices, our backlogs are continuing to grow and average customer wait times are extending. The only practical way to address this in the immediate term is to do everything we can to build more cars on our existing production lines, which is where we are focused.
So just in case anyone had any questions about demand, Zach's saying here that despite the fact that they have exceeded expectations with deliveries, despite the fact that they have exceeded expectations with overcoming the challenges of the supply chain shortages, they are still not able to keep up with the demand because they're still having their backlog getting extended and extended. We'll take a look at that later in the video as well, and you'll see that their supply, their weeks of inventory, has been shrinking. And, so clearly that shows that demand is there.
Financially, our auto gross margins reached 30.5% on a GAAP basis, and just under 29% excluding regulatory credits, which is our strongest yet. This benefit primarily comes from higher volumes, particularly out of the Shanghai factory, increased mix of the Model Y, and we have made good progress increasing Model S volumes. The Model S has now returned to positive gross margin, and we expect this to increase with higher production and the ramp of Model X.
And so this is the part that blew me away. Now, I don't like to add in the regulatory credits because Wall Street bears beat them up for that. So remove them all together, but you still have a 28.8% gross margin, which is insane. And it's up 3% from last quarter. There's another thing we're going to discuss later on in the video, and I'll show you when it comes to their gross margin growth. But, he reiterated here that the S has just gone profitable again, so that's only going to grow even more. And, they're still ramping up other vehicles like the X that are going to be high margin as well. So I'm predicting that Q4 margin should be over 30% without regulatory credits.
As was the case in Q2, there was some net benefit from pricing actions. However, this remains small in the context of other contributors. Please keep in mind that given backlog, it will take time for the impact of recent changes to flow through our financials. Note that we are also not yet recognizing additional revenue from the FSD beta program.
And this is another huge key piece to the gross margin. If FSD hasn't even been, factored into their gross margins here, it's such a small piece of it, that's all profit. So once they do start recognizing those revenues, their profit margins are going to skyrocket even more because it's all profit.
Supply chain challenges, including expedites, continue to provide cost headwinds, as was also the case with FX this quarter. While we are seeing an impact from the rise in commodity and labor costs, we have also been adjusting pricing, which should help to compensate. Overall, as I mentioned in our last call, our P&L continues to benefit from the marginal profitability of each incremental unit with higher fixed cost absorption. As a result of the great progress on margins, volume, and appropriate management of overhead costs, we were able to achieve an operating margin of just under 15%, exceeding the long-term guidance we've laid out previously.
And Tesla's ability to navigate the supply chain issues, to show their agility in this, just proves why they are so much further ahead than everybody else. They will raise and lower prices accordingly to adjust and compensate. So they're not taking as much of a hit. They put a little bit on the consumer, and obviously they haven't lost the demand either way. So, they're staying with this. So as soon as the costs come down, they can bring car prices down. And, a lot of manufacturers and retailers and people out there are like, oh, you know what, prices go up, we're not going to bring the prices down because we want to keep those margins high. That's not Tesla's mentality. They're strictly raising prices just so that they can compensate for some extra costs. And then when those costs come down, they'll take that away. They have plenty of other sources of income to boost up their gross margins. FSD, they're going to have insurance coming soon, and really ramping up there. So they have plenty of other ways to do it. They don't need to do it with their vehicles.
On cash, we generated record operating cash flows of $3.1 billion and continue to invest heavily in the build-out of manufacturing, supercharging, and service capacity. We also continue to retire high-interest rate debt, including the early settlement of our 2025 senior notes of $1.8 billion during the quarter.
And honestly, they are just so smart with running their business. They've generated significantly more cash flow, and they have then taken that cash flow and paid down their debts. So they're paying down their debts, keep their cash flow, so their cash reserves are about the same as they were before, but their debt is significantly lower. So anyone out there who's trying to get themselves out of debt understands how important that is, and that's huge. There's some debt that's good for you. That's fine. Totally different conversation. But as far as Tesla's concerned, this shows that they really know how to operate their business and use their margins to their benefit.
As we look forward, we are clearly quite a bit ahead of the pacing required to achieve our target annual growth rate of 50% this year. Q4 production will depend heavily on availability of parts, but we are driving for continued growth.
And now, for anyone concerned about Tesla's growth slowing down, they have a 50% growth rate target indefinitely. They haven't even said, hey, here's the end date. So even if you said by 2030, that's still a 50% growth every year for the next 9 years. And in some cases, depending on supply chain issues, could be a little bit less. Other times it could be more. And they have proven that they have been exceeding these numbers regularly. So we might see more than a 50% growth on a few of these years. And that's nuts.
We are also nearing assembly of our first production cars in Austin and Berlin. It's important to stress, while the first production car is an important milestone, the hardest work lies ahead in the ramp. Please keep in mind that we are pushing the boundaries on new product and manufacturing technologies at these factories, which makes it difficult to predict the exact pace of the ramp. These factories will also partially weigh on our margins as we work towards volume production.
So one thing that Zach did say later was, despite the fact that Berlin and Austin are going to be ramping up production this year, and they will have production started by the end of 2021, there most likely will be no deliveries in 2021. And that's significant, that's important. So the production is going to be there, but no deliveries. So we're not going to see any revenue generated from them. So it'll be costs basically only associated with those factories. And as they ramp up, they have different costs that are associated, like, labor costs, any other little things, quirks here and there within the ramp process. But they've seen from Shanghai how to do that. And so they can just cookie cutter those things in Austin and Berlin and figure that out to keep the costs down. And so they've already assumed a lot of the costs up front from these factories. So once the cars do start getting delivered out of them, it will be even faster to get to positive margins on them. And those margins will grow even faster.
Do you still expect to start production of the $25,000 model in 2023? What are the biggest hurdles from now until then?
Thanks, Martin. Yeah, we're working on a strategy to increase our production rates as quickly as possible. I think Zach spoke to that well. And we're doing this while trying to add the least amount of incremental complexity to the business. We don't want to add any new vehicles to our lineup when we're
And the last piece I wanted to add about their gross margins when they're discussing the new $25,000 vehicle, if they start pushing this out in 2023, which that's my guess they will, the margins on that are obviously going to be significantly lower. They're going to continue to find ways to drop costs on it, but that'll be a very low margin vehicle. So their first focus is going to be Cybertruck. That's the next thing they're going to do. They're going to start getting those out by the end of 2022. That's going to be another high margin vehicle. So, and to anticipate the margin hit from the $25,000 vehicle, they need to make sure that their margins are super high for everything else. I'm guessing that they're going to be pushing for a 35 to 36% margin overall between Cybertruck, SX, and their current lineup before they drop that, because once the $25,000 vehicle comes out, their margins are probably going to drop back down below 30, and everybody's going to freak out. But you got to remember that 30 is still insanely high. This is just my personal predictions. I don't know their actual thoughts. I'm just kind of running rough numbers in my head as to what the game plan might be going forward, seeing as everybody focuses on margins so that they can keep those margins high. So one of the things that I had noticed was their gross margin. And if you look, usually Q3, it's pretty high. Then it drops down for Q4, grows Q1, grows Q2, and then grows big again in Q3. I'm not sure if that's just because of the Shanghai ramp, but seeing as the ramp of Austin and Berlin are about the same, I'm going to guess that once those two factories open in Q4, they're going to absorb a lot of those initial gross margin hits from the initial ramp-up process. And so we might see lower margins in Q4 strictly based on that, but then we'll see the growth over the all of 2022 because all those costs are already taken into account in Q4. And we'll just see a huge growth next year in gross margins again. And again, they've got, cash flow that is back at its highest levels it's ever been. So they're going to be able to take that and utilize that cash flow for ramping up Austin and Berlin. They hit the 28.8% gross margins without regulatory credits. Absolutely insane. And of course, we see the revenue is 57% year over year. For a growth company, this is expected. Obviously still awesome. Doesn't blow my mind because it's kind of expected out of Tesla. But the biggest thing is they have utilized this growth to reduce their debt. And that to me shows signs of maturity and a wise leadership when it comes to finances. Another thing that was touched on during the call was their inventory levels and their demand. So as you can see here, they're down to 6 weeks of inventory, which is super low. And, it just keeps on dropping because the demand is so high. And they did mention later on in the call that their supercharging stations doubled over the last 18 months, and they're looking to triple that over the next 2 years. So they're going to be building themselves the great foundation. And don't forget, they're also going to be letting other EV makers utilize those superchargers. So it's just going to be Tesla everywhere. And as far as production updates go, they're saying Fremont is at 430,000 for production, and they're going to bump that by another 50%. So that's pushing over 600,000 there. You've got Berlin and Austin coming online end of this year to start production. So they're going to ramp up, and by the end of next year, they'll be at 500,000 each. And Shanghai is already pushing, 250,000 per quarter. So next year's production is going to be nuts. One of the other things I did notice on the call was how passionately they spoke about insurance. And that is a huge focus for them right now. Again, that's going to be another giant margin driver because so much of that is going to be pure profit. So they're really dedicated on driving their insurance to push these margins even higher, which again, the more stuff they can have like FSD and insurance to drive margins higher means that they can drop costs and prices of their vehicles, allowing them to have a better product for a lower price, thereby pushing their competitors even further out of the picture. And, their margins, they're saying it right here again, their margins are going to continue to grow over time, leading the industry without question. They've got plenty of cash flow, plenty of liquidity, no questions whatsoever that this company is just going to continue dominating going forward in the future. And you can just see their gross profits just growing. And I apologize for some reason I couldn't highlight it, but whatever. But you can see here the gross profits right in the middle of the screen just keep growing quarter after quarter after quarter, getting bigger and bigger. That just shows you that the growth that they're on is going to take them so much further in the future. Thank you again, everyone, for watching this. I hope you got some good information out of it. Again, give me some feedback. I'm growing my channel. I'm really enjoying doing these and sharing this information with you. Love the discussions having in the comments and that whole thread down there. So please keep it coming. Really digging this. Again, give me any feedback you've got. I'm learning as well with all this. Love it, appreciate it. Subscribe, like the channel, and we'll see you next time.